So thanks everyone. Thanks Louise. We all know the cars we drive today have far more electronics than the cars we drove in the past. The cars of today are far more high-tech and efficient than those we bought 20 years ago. Now, in terms of that trend towards increased connectivity and efficiency, that's driving demand for many individual parts, a major one being sensors. And speaking from personal experience, on Sunday I had, the dashboard light up with some unknown sensor having gone off to some issue with, the engine of my car. So, I'm sure we've all had those experiences. A major beneficiary of that trend towards increased connectivity and efficiency is Sensata Technologies. So this company is a global leader in the design and manufacture of sensors and circuit breakers. They're a US listed business, and in terms of the products they produce, it's sensors that go into passenger vehicles, heavy on and off-road vehicles, and various other industrial applications, including the aerospace industry. And a single plane might have up to 1,500 Sensata products in a plane. So, heavy use across many different industries. If you look at the cost of these sensors, it's very small in the scheme of the vehicle or truck, but mission critical. They don't produce the sensors, the commoditized sensors that might be the side mirror of your car or the bumper. Their sensors go into measuring such areas as tyre and brake pressure, transmission input speeds, chassis stability control. So these sensors can be life or death if things go wrong. So, in terms of this trend towards increased efficiency and connectivity, they're a key beneficiary. And as we get more autonomous vehicles, that's another key driver of this business. If you look at the history, so it's US listed, but it was originally spun out of Texas Instruments, which is a large US corporate. It spun out in 2006, and in 2010 it merged with Honeywell's sensors business to create the current Sensata Technologies business today. The management team has a long history with the business. The CEO, Martha Sullivan, was with Texas Instruments since 1984 and became CEO in 2010 and has delivered extremely great results over a long period. So in terms of what we look for in a business, it's strong management teams, favourable industry dynamics, strong earnings growth potential, and a compelling valuation. And Sensata really ticks all those boxes for us. To put some numbers around sensor content, say in the passenger vehicle market, if you look at the US and Europe, an average car has about $33 worth of sensors. If we move to more of a hybrid fleet, that number goes up to about $36. And whilst early days, in the electric vehicles, it looks like there'll be about $45 worth of sensors. So a great trend and tailwind there as we potentially get a change in the car fleet mix. So in terms of the results the company's delivered over time, they've had very strong organic growth and double-digit EPS growth over the past 5 years, and we think the future looks bright as more sensors go, as the sensor content per car goes up. That's only the passenger vehicle market. If you actually look at the on and off road heavy vehicle market, they're actually seeing stronger growth there. And if you look, the market there had been flat last quarter, and the company still grew 9%, and we think that market is turning. And if you look at particular applications, it might be autonomous trucks on mine sites. If you look at tyre pressure monitoring across truck fleets, that isn't standard, but is changing. So we think there's a long runway of growth, both in passenger vehicles and those heavy vehicles. So, you know, an exciting future for the company. In terms of the margins of the business, we think they can go up over time, driven by operating cost efficiencies, operating leverage that we think they'll get. They've done a couple of small acquisitions where the synergies are yet to come through, and they're driving manufacturing efficiencies across their plants. Finally, we look for catalysts that will change the valuation of a company, and we think there's two in this case. We think there's the potential for an earnings surprise, and we secondly think that capital management has been an element missing from this story. Historically, they've had an inefficient tax structure. They were domiciled in the Netherlands, which meant they paid 15% withholding tax if they did share buybacks or paid dividends. But they're re-domiciling to the UK, and the final approval should come through on the 31st of May, in which case they'll be able to start paying dividends. So in terms of ticking the boxes for us, a quality management team, strong industry positions, earnings growth potential that looks exciting, and a valuation that we think doesn't reflect that. In terms of the valuation, so if we look at the more commoditized auto parts companies, it trades in line with these players, despite having margins 2 to 4 times higher than those players. We think it should be viewed more as an industrial technology company, but yet it trades at a 40 to 60% discount to its peers in this group. So yeah, ticking the box on valuation for us, with two catalysts in the form of earnings surprise and capital management about to begin.